Equity markets are euphoric, with the Nasdaq notching new all-time highs this month. But is the optimism overdone? And are we on course for a come down soon?
Whichever way you cut it, the US market does look very expensive. You know, the Magnificent Seven or the Seven Horsemen of the Apocalypse, whichever way you choose to view them, you know, have really been the key driver.
The Magnificent Seven are no mystery. Tech stocks like Apple and Nvidia, the semiconductor superhero, have sent US equity markets soaring.
The Nasdaq setting a record. The S&P 500, we're still waiting for that to settle out, but it looks like we may have gotten a record there as well.
The headline numbers look strong, but it's really only driven by a handful of companies involved in artificial intelligence. And they took a bit of a hit last week. Recent research from Morgan Stanley said S&P 500 concentration is at an historical extreme, which it warns increases its vulnerability to a steep correction.
The chance of a 10% correction is highly likely sometime between now and the election.
The US is just entering its earnings season, where companies will reveal if they're actually expanding in this economic cycle. Expectations are high, as are valuations. The current price-to-earnings ratio of the S&P is sitting at 26 times, according to FactSet and CMC Markets. That's above the 10-year average of 21 times. Salt Funds Management's Matt Goodson is in the slightly bearish camp. In this interview, he explains why concentration could be cause for concern. Well, Matt, thank you so much for doing this. I really appreciate it.
Oh, pleasure.
Good to be in here.
Great.
Let's start talking about US equities. Pretty incredible US equity markets, but surely unattainable. What do you think?
Look, the US market as a whole has done 18-19% this year, but the S&P equal weighted index has done about 4%. So it's been a really narrow, concentrated advance. You know, the Magnificent Seven or the Seven Horsemen of the Apocalypse, whichever way you choose to view them, you know, have really been the key driver. And you know, net narrow leadership, it's not unusual. You look back to past booms, the leadership does get pretty narrow, but this time around it really is concentrated.
Yeah, we've heard of instances like the Nifty 50 in previous market cycles. How narrow does the Magnificent Seven compare to previous highs?
From the stats I've seen, this is more narrow than that episode in the 60s and early 70s, and more narrow than the Nasdaq boom in the late 90s. So this is as narrow as it has been.
That begs the question then, it must be pretty fragile.
Possibly. It really depends on, is artificial intelligence the internet, in which case it's not, or is artificial intelligence blockchain or the metaverse, in which case it most certainly is very fragile. And those are the questions which lots of very smart people are grappling with and have varying views on, although the market's view is pretty clear.
Have you got an answer?
No clear answer, but I think what we're just starting to see the beginnings of a little bit of skepticism, because the question is, you're seeing $1 trillion plus invested in the infrastructure for artificial intelligence, and you're just starting to see the question be raised, I think this week by Goldman's and Citigroup in the US, what are the returns? What's the use case for all of this investment? Are you going to get a 10% return on capital out of us? And that's a tough question. Some of the builders of all of this infrastructure are going to get those returns. So if you look at, say, Infratil and CDC, they've locked in very long-term contracts with big, deep-pocketed counterparties, so they'll be fine, they'll get the return. It's just the counterparty who's in the data centre that maybe they will in 5 years' time, maybe they won't, and that's a difficult question.
How much of it do you think so far to date has actually been driven by earnings? Obviously Nvidia has outperformed, but from now on the expectations to continue to outperform on top of that just get higher. So how much has earnings been part of this play and thematic so far, and how much of it do you think it will be going forward? Yeah,
earnings matter, but there's been tremendous multiple expansion. And also in this phase, your earnings quality can perhaps get just a little bit questionable. So for example, when a company buys a whole lot of Nvidia GPUs, they will, that will be a capital investment by them, which they depreciate over many years. Whereas Nvidia reports all the earnings, obviously in the year that they sell all the GPUs, which is fine. That's the way it is. But when you're in this rapid growth phase, it can tend to goose the earnings a little bit, of the key providers. So it's partly earnings momentum. For example, we've seen Tesla rally 40-45% in the last few weeks on less bad than expected quarterly guidance.
That's not good guidance, that's just less poor, right?
Exactly. So earnings has something to do with it, but there's a lot of hype as well. A lot of hype and a lot of momentum and a lot of quant money driving it too.
You work with Morgan Stanley, they take care of your global equity shares fund.
Yes.
Mike Wilson, the head of US equities strategy, has suggested that we could be on course for a comedown, that a correction in the double digits in the US markets is not unlikely ahead of the US election. Are you in that boat with him? Do you agree?
Look, it's a perfectly reasonable call. Now, there's two parts to the US market, right? There's the Magnificent Seven, and that could keep going or it could fall away very quickly. We will know when we're older. Picking the end of what may be a bubble is incredibly hard, so it could keep running for some time. And then there's the rest of the US market where their economy is now unequivocally slowing as the impact of Fed rate hikes in the past are finally taking effect. Now, they've been sheltered for a long time by recklessly loose fiscal policy over there, but now it's really starting to feed through to their economy. So areas, for example, like home building are really starting to come quite quickly off the boil, and parts of retail in the US are really slowing quite quickly as well.
This is a really interesting point, Matt, because if you look on the face of it, if you look at market returns, they look incredible, right? Obviously, we know that that is narrowly driven by a few magnificent stocks. But it's not actually a story of economic expansion, is it? So what it looks like on the tin is not actually what's happening underneath, right?
Yep. Well, it depends where we enter with what the Magnificent Seven are doing. So, for example, with artificial intelligence, if we can find the use cases and costs can rapidly scale and come down, then it will ultimately be a story of economic expansion. But that's the question, and we're just starting to see some people, ask it for the first time, really, rather than just roll with the flow. With the internet, it was a lot simpler. When the internet became fast enough, it was incredibly disruptive to existing business models, dramatically lowered the cost of doing business. Now there were use cases galore. With AI, it's it's just a little bit more of an open question at this point. So it could spark rapid future growth, but can it lift productivity in a manner that's cost effective? And that's the open question that will, I think, ultimately determine how you do from investing in Nvidia and some of those other stocks at this level. And similarly, Tesla, you'd have to say that electric cars have sparked a lot of growth, but it's fascinating the share price has rallied so sharply at a time when electric car sales are falling off a cliff. And it's it's only really high. It's partly the cycle, and it's partly the fact that hybrids have become the go-to.
But isn't that because investors now, or at least some, believe that Tesla could be a strong AI play?
Possibly. It's a very interesting belief. Yeah.
Sounds like you don't believe it.
But that's not their core current business. Is the building of cars and the building of batteries.
Believe it or not, I actually am an optimist, even though I sound very much like a cynic in this conversation, Matt. But I think it's an important question that we ask, who's holding the bag if this does all go wrong for US markets? We know that retail investors, the so-called dumb money, I hate that term, but it is a term, has piled into Nvidia, especially this year. I know some instos that are shorting it. I also know some that are long, but I certainly know some that are shorting it. So if this does all go sideways, who's going to be holding that bag?
Yeah, well, I don't know if there's too many who are shorting it who are still going to be alive. That's a very hard road. Look, in the US, institutional investors are a much larger proportion of the market than they are in New Zealand. The US is a massive domestic market, so domestic US institutions are a huge proportion. Passive, obviously, they have to own a proportion of the index and do. And a significant amount of very light-footed quant money, and a range of active funds which have positions all over the map. And then obviously retail. It's one of the other fascinating themes outside the Magnificent Seven is despite money getting a lot tighter, there's been this meme stock resurgence this year in names that have no fundamental basis whatsoever. Everyone knows they're a pyramid scheme, but people have been willing to play it.
You're not buying GameStop then? You're not buying GameStop in here, Matt?
No, but certainly not shorting it either.
Just don't play that game, I get it. It's a dangerous one.
Watch from a distance.
From the sidelines.
Yes.
We were talking about this a little earlier, and what I think has really been shown this year is also this highlighting this picking winner strategy, because the people who would have been in Nvidia early would have made absolute bank. What do you think this year has done for that whole active versus passive movement? And if things don't work out with this Magnificent Seven, could that mean that active is over?
By and large, it's been tricky for active. A lot of traditional active managers, I think, have been caught a little bit by the extent to which these stocks have gone. Whereas passive's obviously just owned it, and more momentum-based money's done pretty well out of jumping on the theme. The question will be, though, is when the tide does go out, and it will one day, who's naked? And that, I think, will be the real acid test for the active versus passive debate, because if active can't add value when things do change, that's when it will be quite tricky for it, I think, as a thematic versus passive, or as an investment style rather.
So really the real test for active managers will be if this doesn't work out and if things start falling.
Exactly. When things get choppier, when we have a decent pullback, which will happen at some point. It's been a long time since the last 10% plus pullback. That'll be, I think, the acid test for active. You'd better hope and I'd average it outperforms then.
What could trigger a double-digit downturn? You've said there that you don't think that's outside of reality. Would it be a US election? Would it be an oil crisis? What, if anything, could cause that?
There's probably three key things. One is if the US economy slows even faster than is generally expected right now, and you start seeing really disappointing earnings outcomes, obviously outside the Magnificent Seven, that could certainly trigger it. Secondly, if rate cuts disappoint, the Fed does look poised to potentially cut rates, but they've got the problem of Donald Trump looks likely to assume the presidency, and if the Republicans get both houses, you could have a massive negative supply side shock for the US economy via significant immigration curbs, big tariff, so they will be highly inflationary, which puts you in an incredibly difficult position as the Fed, as it makes it very hard to cut into a slowing economy. So that, I think, is going to be quite a tricky point in the macro for the US market in the next few months. So the politics are almost going to matter as much as the economics. There's also, I think, significant risk around the US fiscal position. They are running a cyclically adjusted deficit of 6-7% of GDP. That deficit will only grow if there's ever a decent recession in the US. It's a reckless fiscal policy, which the rating agencies who have downgraded the US have said part of the reason they've done so is there's no institutional capability to rein that fiscal policy in. So that's a danger in time. So you'd probably see longer term bond yields rise in that scenario. And probably the other thing is purely on the Magnificent Seven. We're just starting to see these questions asked. What is the use case? What are the returns to the investment? On the other hand, if Nvidia comes out with a far better chip that's far faster, then one can only think, where might the share price go then? So, you never want to underestimate technological process. It's very easy to look at the multiples, get all bearish, and not understand just the rapidity of the tech progress that can be made and the use cases that develop from it. So while we sort of look at it and scratch your head, you have to be a little bit careful and think about what could be if things go right. Of
course, there's the pricing in the market, then there's the actual underlying business that you will need to take into account as well.
Yeah.
Everything you've just listed off there, though, those are all questions at play in the market, and investors hate uncertainty. How are prices and valuations where they are now when there's all of those enormous questions, political questions at play?
Yeah, no, it's a very good question. Whichever way you cut it, the US market does look very expensive, whether it's on various valuation ratios. One indicator people occasionally look at is the so-called Buffett indicator, which is total US market cap to GDP. It's just set a new all-time record, higher than when interest rates were zero. Now, part of that's because the market's dear, part of that's because more of the US business sector's listed than it used to be. But make of that what you will, the multiples are up there. People are believing in good case outcomes. Maybe they will come about, but if they don't, that's where the risk lies.
On the spectrum of bull to bear, Matt, where are you sitting currently? Square in the middle?
Ooh.
You're allowed to be a centrist, that's okay, but if you could lean one way.
It depends on by market. I think for the US market, moderately bearish. But I certainly have to say from here. Whereas conversely, for the much benighted Kiwi market, which has struggled for years, have to say moderately bullish from here as we finally enter a rate cut cycle. Quite a divergence.
Well, perfect, because I was going to ask you about our market just while I have you, cheekily. When do you think the Reserve Bank may actually cut rates? Are you in the November camp? Do you think earlier is a possibility?
Yeah, it's interesting, isn't it? They're quite mercurial in their decision making, from being surprisingly hawkish in May to giving a speech, walking it back partially last month, and now walking it back further yesterday. What we think they should do is a first cut in August. What they'll probably do is really set the groundwork for it in August, and then possibly even do 50 in November, certainly 25. Interestingly, the market's pricing about 60 by November, with a 50% chance of a cut in August, is where the market's pricing it this morning. And what's changed is we've seen the economy slowing for quite some time, but inflation's been really sticky. Finally, over the last few weeks, we've started to see some evidence that inflation's finally coming down. So, the medicine's finally doing its job.
So you think they're going to signal pretty hard over the next few months, and then we'll see something? If we do, when, of what size are you talking about?
I would hope they do 25 and 25. I suspect what may happen is 50 in November. But look, it's going to be data dependent. There's going to be a lot more data to come out, and they're clearly paying attention to things like, the monthly ANZ Business Outlook survey, the Massey University GDP and inflation now data, those sorts of things. So, which is good. They made a mistake in May. It's good they haven't dug themselves a hole. They've looked at the evidence and they've changed their view.
A 50 basis point cut on the face of it could be quite shocking, but the market's already pricing it in, so it would be unlikely to change anything. If
they don't do 50, if we see a surprisingly higher inflation outcome, that's where things change again. And the market's pricing mid-hundreds over the next 12 to 18 months.
What does it
take us back to sort of low fours for the OCR.
What does it say to you, the fact that the market for months has been pricing rate cuts in way ahead of what the Reserve Bank itself has been forecasting?
The market is an excellent weighing machine at times, and I think on this occasion the market's got it right. And fortunately, the Reserve Bank, while they had it wrong, has seen the evidence and changed their view. So at one point it's frustrating and sort of puzzling that their May statement and just what economic models were they using. But thankfully they've looked at the evidence and changed their view.
Now I do just want to go back to the New Zealand equity market, because before I came down here, Matt, I just had a quick look at the latest on your long-short fund.
Yes.
Your largest long position is on our insurance company Tower, and I've just released an insurance episode, so my head is still full of all of the complexities of insurance. Please give us your brief bull case for Tower.
Yeah, we were right a bit early on it. It's fair to say it hasn't always
good on you for getting that in there.
But it's been a phenomenal performer the last few months. Look, insurance is a classic cycle, and they were caught by rapidly rising claims cost inflation, and you can only reprice for that gradually as your policies roll over the course of a year. And their reinsurance costs went through the roof, and they had a whole series of events. Crime was significantly higher than their assumptions, so it wasn't just the cost of the claims, it was the quantity of the claims was way higher than they'd expected when the insurance was priced.
None of this is sizing up to a bull case, Matt.
No. But of course, what's finally happened, and if you could look forward 12 to 18 months and see it in slow motion, is that they've been able to reprice for the cost inflation, if I've been able to reprice for the greater quantity of claims and for the higher reinsurance costs, and just as I've gone through repricing all of that, suddenly the reinsurance costs are starting to not go up as quickly. The quantity of claims has stopped rising, and claims cost inflation isn't as nasty as it was. And then the cherry on top is, after several years where we had a series of catastrophes, this year there have been none. So they have a very significant retained deductible that they pay the first hit on major earthquakes, floods, what have you. So that could be a very significant profit increment as well. So in our view, it still looks very interesting. But it is a classic cyclical, and it's finally gotten onto the right part of the cycle. And it's not widely followed, so I don't think people sort of just really cotton on to the earnings power that they're going to have for this year and the next couple of years.
Focusing on that same fund, but looking at the flip side, you're shorting the likes of the Commonwealth Bank of Australia, but also interestingly Wesfarmers, which owns Bunnings and Kmart. They've had pretty incredible times with spending, given that they are cheaply priced. So what makes you not like that stock?
Oh, Wesfarmers is a great business. Kmart's a great business. My wife loves it.
I feel like that's a signal to her to stop spending there.
No, she can spend there as much as she likes. It's so cheap.
Very true.
But the issue is the Australian economy is a bit behind ours. The RBA was slow to tighten, probably even has to tighten further even as we ease. Bunnings has gone ex-growth for at least several years, and that's by far the biggest business of Wesfarmers. And at the same time, Wesfarmers is at low to mid 30s PE multiples, way more expensive than it was even when bond yields were zero. So Kmart's a great business and it's growing, but it's still relatively small in the whole. And they've also invested a significant amount in a lithium business, and it's a good lithium business, but lithium is a very abundant element in the Earth's crust, and all of those people who are bullish on lithium are now finding that out, so it's going to be very hard to make money out of it.
So shorting Wesfarmers kind of speaks to that whole conversation we've just had about the fact that it may be a great business and people are still spending there, but its price is ultimately unattractive right now.
Oh, that's right. Yeah, that's right. And possibly a little bit of earnings risk as the Australian cycle slows down at a time when it's at all-time record multiples. So it's certainly, sometimes when you short things, you look for high multiples and downgrade risk, and it fits into that camp. At other times, you look for busted businesses, which could potentially go to zero. Although you have to be very careful with those, because if you get that wrong, they can rise very significantly as well.
We may have to do another future episode on busted businesses. That'd be awesome. Thank you so much for your time, Matt. I really appreciate
pleasure.
it.
Thanks for coming in.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.